Hey everyone, Longacres Finance here, and today I'm switching gears from my usual dividend focus to talk about growth funds in my portfolio. The stock market has seen an uptick in volatility recently, with many news outlets sharing scary headlines about rising inflation, the long-term treasury rate climbing, and you can't skip the next stock market crash videos all over YouTube. So let's take a closer look at what's going on, where we are headed, and I'll give you an update on how my growth funds are doing right now, plus my plan for this asset class in the future. Volatility in the market is very normal, and taking a look at the Chicago Board of Exchange Volatility Index, we can see that on a year-to-date basis, volatility has actually been declining. We can see a few spikes on this chart, but on average it is trending down. If we zoom out to see the past 5 years, we can see that volatility is currently trending higher than it has over the last 5 years on average. And it is about 1/3 of what it was during March 2020. If we zoom further out, we can see that the index peaked around October of 2008 during the financial crisis, followed by a sharp decline, much like what we observed during the last few months. This period of decline was followed by two smaller upticks in volatility in 2010 and 2011. If history will repeat itself, we are due for some more volatility in the near future. Of course, the drawdown period during the financial crisis took almost 1 year from peak to trough, and an additional 3 years to recover back to its previous all-time high. In 2020, we saw a much accelerated version of this with a drawdown period of just over 1 month and a recovery of about 5 months. Does this mean we can expect to see upticks in volatility quicker than during the last market crash? Not exactly. History doesn't always repeat, and the level of fiscal stimulus during this crash dwarfs that of the financial crisis. Therefore, we are in uncharted territory here and shouldn't rely on historical volatility trends to be accurate estimates of future volatility. I recently read an interesting article titled 3 Reasons a Stock Market Correction is Very Likely in 2021. I'll leave a link down in the description below if anyone wants to read the full piece. Typically, I'm very skeptical about these types of articles because nobody knows the future, and oftentimes articles have titles such as this one just to entice more viewer attention. However, the reasons posed here are quite interesting, so I figured I'd share them with you. The author's hypothesis is that if history repeats itself, then we are due for a correction and possibly even a crash this year. The first reason is that historically, stock market corrections have occurred every 1.87 years on average. The author quoted this average from analytics firm Yardeni Research that analyzed data going back to 1950. While this average in itself doesn't imply that a correction will happen this year, it does point out that they occur quite often, about 5 to 6 times per decade. Therefore, we can expect to have one or more in the next few years, possibly even this year. The second point the author gives is that historically a correction has occurred within a 3-year period of every S&P 500 bear market bottom. The last bear market bottom happened almost exactly 1 year ago. Therefore, if history repeats itself, we should see a correction within the next 2 years. Of course, this historical pattern is accurate until it isn't. If we don't have a correction in the next 2-year period, the next time someone quotes this pattern, it'll say that historically a correction has occurred within a blank number of years since the last bear bottom market. And the third and final point is perhaps the most interesting. The author talks about a historically high Shiller PE ratio. If you're unfamiliar with this ratio, it was popularized by economist Robert Shiller, who built upon Benjamin Graham and David Dodd's work. You may know Benjamin Graham as Warren Buffett's mentor and teacher. Without getting too technical, the ratio is a cyclically adjusted price-to-earnings ratio, and its main use is not only to value the stock market, but also to gauge potential future returns. Okay, so the author quotes the current Shiller PE ratio as 35.2. That is almost double the long-term historical average ratio of 16.8, implying the stock market as a whole is overvalued right now. And while the ratio can sustain higher than average periods of time, historically a prolonged ratio above 30 has always led to a correction or a crash. This is all fun to read, but it doesn't quite give us much perspective where the stock market may go in the short term. And while I don't speculate on short-term market movements, because it is a very difficult thing to do consistently and accurately, I do like to know what is driving investor sentiment. You may or may not have heard more news recently about rising treasury yields, and more specifically the long-term yields, which are less controllable by the Fed. This can be tied to an increased expectation of a stronger economy this year and rising inflation. While the Fed predicted that the second half of 2021 would see strong growth in the economy as more of the country reopens following the vaccine rollout, I think the market is expecting to see this growth sooner. I also think we will see inflation, which is normal and expected in a growing economy. But I think that inflation will be within reason, and the Fed won't be forced to raise rates anytime soon. The Congressional Budget Office is forecasting a 3.7% GDP growth in 2021, and slowing growth over the next decade. This low expected growth, coupled with an overvalued market, may be why a lot of analysts and famous investors are warning about a lost decade being on the horizon. Looking at forecasted US equity returns over the next 10 to 15 years, we can see pretty conservative assumptions from large institutions. BlackRock is calling for a 5% average growth. JP Morgan is at 4.1%, and Morningstar is quite bearish, expecting no growth at all. These are just estimates and should be viewed with skepticism. If we look back in history, we can see examples of a lost decade at a few different times. One such period was between 2000 and 2007. I know that is only 8 years, so not a full decade, but we all know what happened shortly after 2007. The stock market had a huge bull run from the mid-90s through 2000, followed by a large crash. And it took any money invested in 2000 until 2007 to break even. Of course, most people don't invest this way. Instead, you invest money weekly, monthly, or sporadically throughout the year. And those investments did not take that long to provide returns during that technically called lost decade. The prior lost decade occurred between the late 60s and the late 70s, where the broad market experienced 2 crashes. So where is the market going now? The honest answer is nobody definitively knows. Half the people making these projections are bullish, and the other half are bearish. And one side will be right, but I think more so by luck than any pattern or news. Because the near market movement is so hard to predict, and there is always a chance of an unforeseen correction, I don't concern myself with predicting where we are headed in the short term. Instead, with respect to growth funds, I focus on a long-term outlook like the next 5 to 10 years or even longer. And my long-term outlook is optimistic that growth will continue. And seeing how I'm continually adding money into my portfolio, if the market has a correction or a crash, I will continue to add capital to my growth funds, lowering my average cost basis. If you liked the video, please click the like button and subscribe to my channel so you don't miss any future videos. With that said, let me give you an update on how my growth funds are doing right now. I own a total of 14 growth funds. My 2 primary holdings are Vanguard's Growth ETF, ticker symbol VUG, and Vanguard's Information Technology ETF, ticker symbol VGT. I own 12 and 9 shares respectively, and each position is valued right about $3,000 right now. My positions also happen to be up about 25% right now, which is pretty nice. The other 12 funds are all valued right around $1,000, with the exception of my latest 2 additions. The rocket and UFO funds have substantially less money for now. I have added these 2 ETFs to get more exposure to space stocks, but I may liquidate both funds when the ARK Space ETF finally launches in the US and move the capital there. I will have to wait and see what holdings will be added to the ARK ETF versus what holdings are currently in my 2 ETFs right now. So far, my position in these 2 ETFs is at a loss, but I just recently started buying shares and will continue to do so until my target positions are filled. At that point, I will continue to add 20% of my weekly contributions into the most undervalued growth fund as compared to my target allocation. The small problem here is I cannot buy fractional shares in this brokerage account, with the exception of stocks that are part of the S&P 500 index. Therefore, I only add 1 share every 2 to 3 weeks. I consider all of these ETFs as thematic funds that target a specific part of the economy or theme within the market sector, except for the 2 Vanguard funds. My thinking here is that I am only one person, and it is impossible for me to research and understand all the stocks out there in these varying industries. So rather than spend all my free time doing research, I think my cash and time is better utilized investing in funds that are led by portfolio managers that are 100% focused on a specific part of the stock market. They are also supported by a team of analysts who spend their days researching stocks and identifying future trends. To me, investing in a fund makes more sense, but everyone is different and you should invest in a way you feel comfortable with. I own 2 cannabis funds, Toke and YOLO. Both have dropped recently, but my position remains up about 30%. I own 2 funds from ARK, the Genomic Revolution and the Innovation Fund. These have pulled back quite a bit recently, and I am actually in the red right now on both of them. I own an Artificial Intelligence Fund, ticker symbol AIQ, that is up about 8.5% for me. My Internet Giants Fund, OGIG, is up about 2% for me. My IPO ETF is also up about 2%. The Sports Betting ETF, BETS, is performing nicely, up about 28%. SMOG, the Low Carbon ETF, was my best fund only a few weeks ago, but has pulled back a lot and I'm only up about 5% right now. And my esports ETF, ESPO, is only up about 2%. I believe all these themes and the growth sector will offer great growth over the next 30 years, which happens to be my investing horizon. Therefore, I am not worried whether these funds are up or down right now, because I want them to be up 20 to 30 years from now, so that I can capture gains and shift them to my dividend portfolio before I retire. With my long-term approach, market volatility or a correction or a crash aren't worrying to me because I'll just keep buying week after week. And if Mr. Market wants to offer me the same stocks and funds for lower prices, I say thank you and buy as much as I can. Let me know in the comments below if you are worried about a market correction or a crash this year. That's it guys, thanks for watching, see you next time.